earnings season edition of What Are Your Thoughts? Shout out to everybody who joined us tonight. We got a big audience tonight. We had a big audience last week too. We love you guys who come to the live. Say what's up to Bob Mellon, Nick Cutting, Sam Chisholm. Roger Weatherford started a Bat Cave for all the Batnick fans. What is this? The Bat Cave boys? I'm shutting that down. You know that. Mark Baird is in the house. Christopher Caslin. Jay Luther, what's happening? Mitchell Malinak. The whole crew. All right, so listen, we got a lot to get to tonight. Before we do, quick shout out to Y-Charts, best sponsor in the world. Where's Y-Charts? Bang. Y-Charts has an amazing research platform. If you haven't tried it yet, for any of your stock market or economic research, go to the link below us. And if it's your first time giving Y-Charts a shot, you will get the official What Are Your Thoughts discount. Okay, Google is like the big news tonight, right?
Google
so we don't bury the lead.
That's it.
That's the thing? Okay, what's going on here?
Is it going straight into the Dow? Let's start with that. 20-for-1 stock split. The Dow Jones Technology Average, is that where we're going?
I would argue this belongs in the Dow. I don't see how anybody could argue against it. Just there might not be room for another information technology company. But it's a communications company now. Maybe there is room.
So we've got, what's in the Dow? Apple and Microsoft. Salesforce.
Salesforce ahead of Google makes no sense to me. I mean, Salesforce, great, but it's a $100 billion market cap. What are we doing here?
So, right? All right, here's the story. Throw up this revenue chart from Google. It's just bananas. Yo. So that's not updated for this quarter. $75 billion, up 32% year over year. Full year came in at $257 billion in revenue. That's 41% annual growth. Today, I'm reading this book by Sebastian Mallaby. He wrote More Money Than God, which is the best history of hedge funds. And he did this book called The Power Law, which is about the history of Silicon Valley. And he's talking, so Sergey and Larry were talking to John Doerr from Kleiner Perkins about raising money. And he's talking to them, and John Doerr says, how big do you think this can be? And Larry Page, you've heard the story before, right?
Yeah.
Larry Page says $10 billion. And John Doerr goes, you mean market cap, right? And Larry said, no, I mean revenue.
Yeah.
Okay, that was 1998, so we're 20-odd something years later, $257 billion. And the remarkable thing about these companies is that there's absolutely no historical precedent. I threw up on the blog yesterday that Microsoft is doing something similar, has grown its top line 20% for the last 3 quarters. Now, you might say that's pandemic related. No. These are all-time high numbers, all of them. Growing the top line at 20% for 3 straight quarters. The last time they did that was in 1999 when their revenue was $5 billion a quarter. Now it's 50. What we're seeing here is completely unprecedented.
Companies should not find it easier to grow 20% plus year over year at the size they're at now versus the size they were 20 years ago. That makes absolutely no sense at all to anyone that studied the history of business, which is what makes it unprecedented.
Margins
compare this to?
Margins ridiculous. $20.6 billion in profits, up 36% year over year. So you have these names. Just take the 3 names: Apple, Amazon, Google, are such a big part of the overall market, and they're fundamentally different business structures than we've seen in the past, which again goes to what we keep talking about, using historical metrics to compare today's market. What are you doing? It doesn't make sense.
Yo, but this is why Biden put a communist in at the FTC, Office of Policy Planning. Her name is Lena M. I'm just kidding, by the way. Her name is Lena M. Khan, and her whole shtick is this is a huge problem for the economy, that there are companies that they're growing their share of all economic activity at double-digit rates, and they're already worth trillions of dollars. They're already sucking up all the free employees, and they're just eating up the mind share of America online. And that, like, to them represents actually a problem for the economy, not a symbol of how great our economy is. I would beg to differ. I would look at the experience of Europe for a very easy comp for why we have a better economy, but I guess it's more philosophical than anything else. Google's going to split 20 for 1. So where would that So I know you don't like talking in points, but as I'm talking,
That's okay.
the stock is up 232 points, and it's at 29.84. Looks like it wants to break or at least challenge $3,000 per share. Where would 20 for 1 put us?
You could do the math. That's 150. So let's just look quickly at the Dow stocks. Where would this put us if this went into the Dow?
It would be a top 10.
Dow is a point weighted index, which is silly, but whatever. So the top. This is why the Dow is kind of, even though for all intents and purposes it's the same as the S&P, it's broad exposure, moves in the same direction. But it is pretty funny to know that the top 6 names in the Dow are United Health, Home Depot, Goldman, Microsoft, McDonald's, and Visa. Dude, United Health, McDonald's, Home Depot, Microsoft, and Visa. Those are the top 6 names in the Dow. But anyway, hold on. This would be top 10.
The reason United Health is the biggest weighting in the Dow is not. I mean, it's an amazing company.
It's a share
but
price.
It's a $468 share price.
Right.
And Apple did a 7-for-1 split
To get
in order, because that's basically what the Dow Jones Index Committee told them would be necessary.
So
Google
actually,
doing 20 for 1 makes
Salesforce
sense.
150 is actually in the bottom. It's middle of the pack, right, just below average. So it's probably going in.
What would come out?
I'm looking right now.
It's not clear to me that there's an obvious candidate to come out, but I've only thought about this for 30 seconds.
American Express, only because we have Visa there.
Oh, Visa and Amex are in there?
Yeah, I don't know if that's necessary.
Ooh.
So let's talk about, maybe Walgreens.
American Express is having a good year, though. They don't usually pull things out that are, like, doing well.
But it's a Dow. There's 30 names.
Market.
It's very difficult to pull one out. You could pull out Amgen. Isn't there? There's Amgen. Is Merck and Pfizer in here?
Yeah. What is the point of Amgen? What are they really doing
Is
for
Pfizer
anybody?
in the Dow? Yeah, right. I thought it was.
I feel like they're not. They're just disappointing people by staying.
Anywho, all right. Let's talk about PayPal for a second. This stock is getting.
Cisco Systems.
Cisco.
Yeah. Fuck out of here. That's enough.
All right. PayPal is getting bludgeoned. The stock is down.
I own this too. This is taking away all of my enthusiasm for what's going on with Alphabet. This is one of the worst stocks I own right now.
Down 17% after hours. The deal was their guidance was really bad. They were guiding towards 523. They're looking at 460 to 475, which is a lot lower.
Can I point out that this is happening while the traditional credit card stocks are racing back toward all-time record highs, and consumer spending has never been more on fire? What the hell is wrong with these people? At what point does this guy step down?
I don't know the story at PayPal. Maybe you know it better than I do. But
the story is the stock is down 50% from its highs last summer.
I mean, there's obviously a reason. Square's not working very well either right now, in contrast with Visa, MasterCard, and American Express, which LOL Chamath, but we won't go there right now. So just some numbers. Q4 payment volume up 23% year over year, $340 billion. Total volume for 2021. This number's so big it doesn't, it's sort of without context. 1.25 trillion, up 33%. They've got 426 million total active accounts.
Isn't it at all possible that disrupting finance is just not that great of a business? Like fintech is just not. Well, look at the share price of SoFi.
Right.
Look at the share price of recently PayPal and Square. I know they had a great 2020, but is it maybe? Look at Lemonade. Is now a sub $2 billion stock. It's almost a penny stock. Is it at all possible that disrupting finance isn't that profitable, and that consumers maybe don't hate their incumbent financial services providers as much as you might think they do? Is that
it's
reasonable?
Possible. It is. I would just say rewind 6 months where Square and PayPal were like the hottest stocks in the world.
Yeah, I know. Well, that was then.
Maybe they just went up too much. I mean, without sounding cute.
PayPal is no. PayPal is actively disappointing. They are cutting expectations every time they report now.
I just told you they did.
That's not maybe they went up too much.
Dude, it was a $360 billion company. It was and now it's 200. It's still big. Maybe it just went up too much.
Maybe they should have went through with the Pinterest deal after all. All right, AMD. This is big for my holding in NVIDIA, and I think it's important for the market. This is a very, very large semi name. Great forecast. Stock up. What is it up in the after hours right now?
10%. That's what I'm saying. Semi's not. They bounced. They got hit pretty good.
Yeah, but these companies, you know what's weird? The semis, they have these sell-offs, but when they actually report, they continue to, in general, they continue to justify why they've done so well in the last few years. And I've been saying that I don't think this is a cyclical business anymore. I think.
Did you listen to Gavin Baker talking about this?
No. Should I?
Yes.
On where?
With Patrick.
Okay, I haven't heard that one.
Why are
yet.
these not cyclical anymore?
That's Invest Like the Best podcast. Yeah. That looks great. What's the other one tonight? GM?
Starbucks. Starbucks did not do very well tonight.
Starbucks had higher labor costs in the U.S. and shitty European foot traffic because of Omicron. Yeah, the Europeans are like running away from Omicron still in a way that Americans aren't. Isn't that interesting?
Starbucks only down a little. The stock's not acting very well. Throw up this chart.
It's already down 25%
Yeah,
from its high, Starbucks.
Throw up this chart with all these pretty bubbles. So I thought this was a good chart. So the size of the bubbles represents the market cap of these names. And on the y-axis, we're looking at the drawdown.
Okay.
And on the x-axis, we're looking at cash flow. And obviously Apple, just ridiculous. So this is pretty interesting.
No drawdown, huge cash flow.
No drawdown, huge cash flow. So the less free cash flow, the more susceptible you are to the current sell-off.
This actually makes perfect sense to me. Doesn't it make perfect sense to you?
Yes, but it doesn't always line up that fundamentals matter in the short term.
No. You know what I would say? Yo, DJ, rewind. Put that back. You know what I would say to you? You know what these three names on the right have in common, in addition to having the lowest drawdowns and the highest free cash flow?
Monopolies.
Well, yeah, but buybacks. And Amazon doesn't do that. Tesla doesn't do that. In fact, Tesla is a seller of stock periodically, especially its founder. NVIDIA doesn't do that. And Netflix doesn't do that. And I think to guard against drawdowns when you're a stock of this magnitude, you kind of need to have a mechanism whereby the Treasury is sucking up stock in volatile markets. And I think if we overlaid announced buybacks to that chart, it would make it even more obvious.
The chart of Apple shares outstanding is one of the most under talked about amazing charts ever. That the shares outstanding went like this and crashed. Apple.
Yeah. So I used to say, every time you sell shares of Apple, understand who the buyer is. One of three people. No, Steve Jobs is ghost. Every time you sell a share of Apple, one of three people is buying it. A, SPY. B, the company itself, or C, Warren Buffett.
Warren Buffett, yeah.
How much Apple do you want to sell? I was saying that shit 5 years ago. All right, are we doing any more on?
But what's going on? What's going on with stocks? Let's talk about this.
Well, this is up as of a lot of this stuff is as of Friday, but let's do this. S&P 500 companies reporting fourth quarter earnings through the end of last week. 165 companies had reported, which accounted for about 50% of the index component's earnings. And their only earnings in general, tonight will probably skew it higher, are tracking 2% above where they stood on January 1st, which is a far weaker performance than prior quarters since COVID started. Earnings per share typically has been up 11% on average by the end of week 3. Net margins are okay, but earnings beats are not as big as they were. And companies that beat on both sales and earnings per share are only performing in line with the market the following day. So sentiment is still high. Valuations are still presenting a problem.
All of this data might look different today.
I think it'll be skewed more positively today, especially if we were to do it by market cap.
I think margins look pretty good to me. Throw up this next chart with all the purple chart with purple lines. This is from Lindsay Bell at Ally. I mean, these margins are pretty remarkable. Consumer costs are getting passed on or rising costs are getting passed on to the consumer. Obviously, let's throw up this chart from FactSet talking about the beat rate. I think we're looking at 80% so far beating. But the S&P 500, we've got year-over-year earnings growth above 20% for the fourth straight quarter. Obviously, a lot of that is COVID, but we should be rolling off of that soon, actually.
Rolling off of what?
Off depressed levels. Off 2020 levels. Yeah, it's 2022.
Yeah, that shouldn't even be part of the conversation anymore. So, what was I going to say on this next thing? Oh, we were going to just talk about why I don't think this is over yet.
Oh yeah, I'll take the other side.
Oh, you think the correction is over for what? For
not necessarily, but You made the
that would be the other side.
No, I don't want to talk about that because who knows. But you made an interesting point where you're talking about about growth stocks, the ones that got killed, and you said there is still such a chasm between where growth stocks are currently valued versus where they may look more attractive to the next wave of potential buyers, which is obviously a fact. However, I think that given that how quickly markets cycle and move, I think that, remember like when AMC rose and died and rose again? I think these stocks can catch fire quicker than fundamental buyers would suggest. You know what I mean? Like, I don't think we need to wait the way that it used to take years for these to play out where value buyers would step in. I think all of that shit is happening way quicker.
All right, so I don't know about that. And I think what I'm trying to say, though, is that not all growth stocks should be spoken of the same. Like, I don't think we should be talking about Meta and Alphabet the same way that we're talking about DraftKings.
100%.
I think that, yeah. So that's first. The second is I feel as though the snapback, the violence with which these stocks rebound is going to be predicated on how many short sellers they managed to attract over the last 2 weeks that now want to reverse those trades. And I feel like that's going to be a case-by-case basis. But big picture, Mike, if you own a stock at 300 from 300 that dropped to 120 during this storm, you shouldn't think that just because the S&P 500 is about to take out its old highs that you're getting back to 300 in those stocks, because you aren't. And in most cases, never again. And that's really the main point that I want to say. I don't think some of these companies will ever find buyers on valuation because they are so, like some of them are just so completely ahead of where the business will ever get to. And I don't know, maybe I'm trapped in one or two of those, but I think it's going to be very tough for people that assume a market rebound means a rebound for the names that they have heavy weightings.
So the interesting thing is like we're seeing a snapback in some of these names, and then what? Right? Like a snapback, Robinhood's up 40% off, 50% off the lows. It's still down 60%. I'm making it up. You know what I mean? So after the snapback, after the depressed selling, then where do we go? So it'll be
right,
interesting.
because a stock making a higher low does not attract momentum investors. It's just that they're not fishing in that pond. They're in energy stocks right now. So who is the buyer? You can't tell me
Ram Capital.
It's an ETF that focuses on innovation, because the innovation ETFs, A, they're being liquidated, and B, what they're actually doing, if you look at how they're buying stocks, they're like concentrating into their biggest positions right now, which is what they should. They're circling the wagons. They don't want to add more money to their 20th best idea. Why would they? Right? So I think it's going to be. I think it's still going to be tough. I don't think it's over.
All right, let's talk about the volatility. All right, SPY thing had $400 billion in assets. Just saw its biggest redemption since launching in 1993. Now, again, these are not, we have to adjust for percentage. It's probably not the biggest for dollars wise. Obviously it is. It's a lot bigger today than it was. So, all right, some $6.96 billion exited Monday. The largest daily outflow in 4 years. The Qs lost about $6 billion. Let's throw some of these outflows up.
Can you explain, Mike? Can you explain to the viewers what you mean by the biggest redemption since launching in 1993? We're talking about people on a net basis pulling money out of the ETF.
Correct.
Yes. So this was the biggest. This was the biggest net sale out of SPY on a weekly basis by investors.
Again,
in 30
dollars
years.
by dollars, not by percentage.
Well, I only speak in dollars. So
I know
that
it
makes
matters.
sense to me.
So dollars. So let's talk about the volatility. What was interesting is that I'm going to lean on Balchunas for a few charts here. He said that the gap between ETFs used by traders, and which is like SPY, and ETFs used by investors, IVV for example, they're both S&P 500, but they're different they're used by different
One
groups
is
of people.
Vanguard, one is State Street, one is liquid enough for traders.
One is State Street's SPY, IVV is BlackRock, but same thing, whatever. The point is, throw up this chart. The gap is enormous.
It's nuts.
Usually they're going in the same direction. Here's one more. So you've got all these outflows and all these people going nuts. Vanguard took in 5 times more cash than any other ETF issuer in January. It's unbelievable. The buy and hold buyers are relentless.
Can you go back one chart, John? Chart back on? Yeah. So the white bar is outflows from ETFs used by traders. The orange bar is inflows, ETFs used by investors, and often these are the same index these ETFs are tracking. It's just like one of them is more frequently used by people who buy and hold.
Right.
This is remarkable.
It's crazy. Eric said the spread between risk on ETFs used by traders versus buy and holders is about as wide as it ever gets, about March 2020 level. The two camps have been on the same page most of last year, but are divided now. And we'll get into more of what's going on in two topics, but we're already running late. So let's just transition to yours and we'll get back to this.
Are we going to do these other two charts? Cruelest month? Or do we cover this?
Month. Where is this? I don't see what you're saying.
Right here. Let's do this. Right after the before this. It's before the black and orange chart.
We just talked about it. We talked about this.
We did that one already?
Yeah.
Okay. Paul Krugman took another swipe at Bitcoin.
Garbage alert.
I don't know.
Garbage.
Make the case.
Total sucked.
Let me read what he said. I disagree with him too, but I think for different reasons than you do. Crypto has been the headline: crypto became the new subprime. No, it didn't. Still, crypto has been. This is Paul. I'll do it in his voice. Still, crypto has been effectively marketed. It manages both to seem futuristic.
Stop. Right. Just fucking read.
And to appeal to old-style gold bug fears that government will inflate away your savings. Huge past gains have drawn in investors worried about missing out. So crypto has become a large asset class, even though nobody can clearly explain what legitimate purpose it's for. There's a lot of other stuff in here about the type of people who are buying crypto. 44% of crypto investors are non-white.
Whoa. Hang on. Before you go to
55% uneducated in college, etc.
Wait, no, not etc. I actually agree with this. Crypto has been effectively marketed. It manages both to seem futuristic and appeal to old-style gold bug fear, so libertarians. Yeah.
And it has literally no point yet after 14
And huge
years. Past
gains have drawn in investors worried about missing out. But here's I don't even understand. There's no point here. He's saying investors in crypto, I know you just read this, but it's important. Investors in crypto seem to be different from investors in other risky assets like stocks who consist disproportionately of affluent, college-educated whites. According to a survey by the research organization, 44% of crypto investors are non-white and 55% don't have a college degree. He's also, hold on, here's why this is bullshit. He's also the type of person, as are a lot of crypto haters, who would say that only 2% of addresses own 90% of all crypto. So who is it really helping? It's not democratizing anything. I'm certain he said that before, and I know it's cool to dunk on Krugman. That's not my intention. I just read this article and I thought there's nothing here. There is literally nothing here. He said, if you ask me, regulators have made the same mistake they made at subprime. They failed to protect the public against financial products nobody understood, and many vulnerable families may end up paying the price. What are you talking about? Right. The price of what? Many vulnerable families. What is he talking about?
I don't know, but I think what he's trying to say is that, like subprime, all right, subprime was dismissed as, it's just subprime, and then it turned out that the whole foundation of the housing bull market was built on extremely risky loans. But where the analogy breaks for me, and I jotted this down so I could do this correctly. The problem with subprime loans was not that people got subprime loans. Like, of course, a lot of them went bad. They're supposed to. They're low credit quality loans. But they actually helped a lot of people buy their first home who would ordinarily never get a loan. The problem with subprime for the whole economy was that the banks did not make the assumption that if things went bad in subprime, it can affect all of the quote-unquote better mortgage bond tranches that everyone was counting on to be rock solid. Historically, we never had a default rate for all of these mortgage products. The problem with subprime was that it was underlying these better tranches, and then we had this contagion. So Krugman is basically, I think he's trying to say that a crypto crash could be contagious and infect the real economy.
But he didn't say that. Then say that.
I know that. But that's what the subprime analogy would be.
But he didn't say that.
You know why?
Dude, crypto just got...
He can't make that case.
Crypto just got cut in half. It just went from 3 trillion to 1.5. If it went from 1.5 to 0, so the Winklevi are no longer billionaires. Like, I know people would be hurt, but would the economy notice if crypto went to 0?
I actually think you're exactly right, and that's why the analogy doesn't work. Systemically important financial institutions, or SIFIs, are not here. They have no exposure. They're barely doing custody. They're doing no principal trading, almost zero asset management.
So what happens if JPEGs go to 0? Some people have to go back to work.
I agree. If anything, the traditional financial system actually would look great if crypto had a 90% wipeout or something. I just don't see where the exposures are. So if he were trying to make the case that, like subprime, a crypto crash could hurt the broader economy, there are no stats in his piece. There's nothing really backing that notion up. It would be an interesting piece to make that case, but he doesn't really try that hard.
It was really lame. I'm sorry. I know it's easy to dunk on Krugman, but this was just nothing.
I wish he would have taken it further and shown us, like, in what way is this like subprime?
Right.
But there really wasn't much of an attempt, other than if you put subprime in a headline, it gets normal people's attention because they remember.
Right.
All right, let's keep moving.
All right, let's talk about bulls and bears. Back to that volatility piece. So this is nuts. So every year, going back to 1980 something, the American Association of Individual Investors asks people, are you bullish, bearish, or neutral?
So stupid. All right.
And why is this stupid?
It just is. I hate sentiment surveys. Okay, go.
It's not stupid. Overwhelming.
Tell me what the market did yesterday. I'll tell you what sentiment is today.
Okay, fine. An overwhelming majority of bulls doesn't really tell you much.
No.
Bears, however, there is some signal there because typically capitulations are an event where everybody on Monday morning says, all right, I'm out.
Yes,
not
I
this
agree
Monday,
with that.
a week, right? So you look at past spikes of bears, and that does line up with bottoms. Now, of course, you have no idea, like, in real time it's tough. But anyway, the point that I want to make here is it's insane how bearish people got. The gap between bulls and bears literally was wider last week than during the pandemic when we were locked at home.
Yeah.
And the economy was on life support.
How did that happen? How did everybody get so bared up that quickly? Really interest rates?
I think inflation and interest rates. I think inflation really scares people.
I think so too. I think so too. Does inflation scare people though more than the potential for 1 million Americans dropping dead?
Yeah.
Of a disease? It does?
Because you don't think you're going to die, but you think that your dollars are going to go away. Like, I know it sounds ridiculous, but
you can't take it with you.
Sentiment Trader tweeted, small options traders spent $6.5 billion buying put options to open last week. That's an all-time high. Volatility intraday action, scary headlines, and a plunge in speculative stocks. There was also that, by the way, the speculative stock plunge. Triggered panic that was 40% higher than even the worst week in March 2020. So it's not just inflation and interest rates. It's also a lot of the stocks that people own got absolutely blown up.
Keep this up. Do we think small options traders are doing $6.5 billion worth of put buying to hedge a portfolio, or is this just more speculation? This is just like more bets to make money in a down tape.
That's okay. I don't think
that's what I think. I think it's the latter.
Fine. Let's look at the next one.
Like, oh, hey, I learned how to short the market. And then, of course, Netflix is 25% over its low, et cetera.
Let's look at the next one. So we know that I don't know if the tail's wagging the dog here, but there's a lot of market structure geeks that talk about like how options are impacting the market. There's no doubt they are at some level. It's hard to sort of untangle what's going on. But look at this. We're looking at index and ETF puts. The chart says it all. Rolling 5-day average. It's this spike is pretty wild.
Everybody's George Soros now.
It's pretty wild. Then quick 2 more charts. I spoke about this multiple times. Somebody asked me like, are we projecting that we think markets are more volatile given that life is more volatile? And it's absolutely not the case. There's some weird shit going on. So I looked at the intraday range from the high to low on the S&P 500 over a 5-day period, and you see the spike on the top chart all the way at the right. And what's interesting about this spike is that there's barely any drawdown. So typically you see the spikes on the top and you see the sell-offs on the bottom. Usually when you see this sort of volatility, we're in a bear market. So on average, when we were where we were over the last 5 days, when I made this chart, the market was on average 32% of below its highs. This time around, we were only like 11 or 12% off. So really weird shit. And then the last chart, another one showing basically the same thing from Goldman Sachs. The median 15-minute S&P futures return has been by far the highest since early 2020. So yeah, markets are really volatile.
That's wild. We have a question on the tape from Rachel. What's up, Rachel? Asking, is TD Ameritrade a stock I should buy? Who makes the money from options trading? Look no further than CME Group.
Yeah.
CME made a record high last week as the stock market was in the depths of its drawdown. This is the exchange where people are making interest rate bets.
Chart looks amazing.
Making big market bets. And you could actually see this stock come off its high as the VIX starts to collapse.
SIBO looks pretty good too. Pretty good too.
This is where pros do their hedging and their futures trading and their volatility bets.
So anyway, bears got all bared up. We got to bounce. Obviously, things look, Google looks good. We'll see where the market goes from here. But just last thing, I'm not a big market cover indicator guy, but this is sort of notable from Bloomberg Business Week, the big chill.
It's whack. What is that on it? Is that its tail frozen in the air?
Yeah.
That's a little weird, right?
All right, let's talk about Buffett.
They should have, shown that. Put that shit back up, like in Empire Strikes Back, with like a big slit through it, and Luke Skywalker sleeping inside of it for warmth.
Actually, they should have done the Revenant,
not feeling that
sleeping
cover.
Inside the bear. Oh wait, did he sleep inside of a horse? That wouldn't work.
Well, no, that's in Leo DiCaprio.
In
yeah,
the
he slept in his own horse.
Horse, yeah.
The bear. Like the bear assaulted him.
What a scene
almost sexually. It was odd. Okay, I don't want to go any further into that. What else are we doing?
Move on.
Buffett. Yeah, this is like the main event here. Okay. Banks, energy firms, and other value stocks have rallied this year, which is great news for Buffett since the Oracle of Omaha's conglomerate invests in many of these companies. Many of Berkshire's top investments are financial firms, B of A, Amex, U.S. Bancorp. Berkshire's portfolio has also gotten a boost from Chevron. Stock is up 10% this year. It's Buffett's 12th largest holding. So think about his collection of businesses, all stuff that makes more money when there is actually inflation. The railroad, shipping, the utilities. These are companies. I mean, Apple.
By the way, you asked me how much Apple pays Berkshire in dividends. Did you see my answer?
So $780 million is going to transfer from Apple to Berkshire.
That's
for
insane.
Dividend payments. That's nuts, dude. Think about
$780 million.
Think about Apple owing Berkshire $800 million in dividend payments this year. It's unbelievable. Plus, if there's continued volatility, Berkshire gets to buy back its own stock, shrink its float, which is something it started to do. They have $150 billion in cash. If one of their favorite names gets whacked, they could potentially do an acquisition. So I think Berkshire works for a plethora of reasons this year. One of the better performing names in the market, right?
Stock looks great.
Yeah, stock looks great. I'm long, full disclosure.
I was looking on the Wayback Machine on the internet for something on the Wall Street Journal, and I stumbled along the 1999 section.
Throw it up.
And I didn't pull this, but it was 1999. It was the end of 1999, and one of the headlines was Warren Buffett offers a mea culpa, because in 1999 Berkshire had the worst relative performance by far ever. He
wasn't in tech.
Yeah, we saw something. I think he actually was down 1% on the year. We saw something similar in 2020. Obviously, Berkshire did terrible relative to.
Wait, so go back, John. Pop this Buffett magazine cover from 2001. This is not the first time Buffett was told he doesn't understand the market anymore and he's out of touch, and then has emerged and come back on top. This is 2001, after the NASDAQ has crashed by 85%, and all of these .coms basically were liquidated.
He's been 80. He's been 80 for 40 years.
He's been 80 since before I was born. Yeah. It's actually unbelievable. We have this Berkshire versus ARK. So
basically, all of the outperformance over the pandemic has been ripped away.
The whole thing round tripped. Can I say one more thing about Buffett that I think I got wrong, but I want to correct the record. Not that anybody cares what I think. I was one of the people that was like, what the fuck, when he sold all those airline stocks at the bottom. He didn't panic. I have come since.
All right.
No.
Explain. Okay.
Can I?
Please.
I have since been educated on this topic. think about this. If he didn't sell the airline stocks and remained the majority shareholder,
well, they got bailed out.
Is there any possible chance the federal government would have been able to bail out these companies and keep them alive?
Maybe.
No way.
It would have looked very bad. I understand. Yeah, I remember he made that point.
The world's richest man is the largest shareholder in these 5 airlines, and the federal government is going to take taxpayer money and save them. Yeah. Would never have happened. So I think he got a phone call and somebody walked him through like what the potential rescue might be. And basically, Mr. Buffett, you literally have to take this loss, or maybe 500,000 people are going to lose their jobs. I honestly think he sacrificed himself to save these businesses, and he'll never say it. He'll never say it. I'm saying it, and I hope people say it at some point in his life before he's gone.
Okay.
I hope somebody gives him his due for that. Anyway, congrats to
that's a good point.
That's a good
point. That's a good point.
You're up.
All right, rate hike palooza. We got some crazy calls last week. J.P. Morgan sees 5 hikes this year. Bank of America 7 at every meeting. Morgan Stanley 4. Deutsche Bank 5. So
7 will be wrong.
It's every meeting. What would that take it to? I can't do the math quick enough. 0 to 25, whatever. It would take it to a
2% interest. 7 would be 1.3% Fed funds. It's not going to happen. It's not going to happen. Where's the 10-year? 1.8.
So
they're not going to invert the yield curve on purpose.
A month ago, I'm looking at the March meeting of the CME futures, which does this implied probability of what the market thinks rate hikes are going to be. A month ago, I think it was 45% of market. There was a 45% probability that in March rates would remain unchanged, 0 to 25.
We did this bet on Kalshi.
No, I missed it. Now it's 0. So there's basically everyone's saying their market's going to move. So what did I do? Went the other way.
You went the other way?
Went the other way.
So wait, what's your bet?
So I bet on Kalshi that that they're not going to go.
This is Kalshi.com, by the way.
That they're not going to hike.
They're not going to hike in March.
So listen, I can't. It's 95% odds. I'm not going to bet $100 to win 5. Why would I do that? Right? The market has spoken.
I did that, but I did it early enough that.
Hold on, put that chart back on. Rewind. Look at the green chart. You could have got this for even money earlier in the year, at the end of December, early January. It was even money.
I think I did this in the middle of January.
Okay,
so I'm not getting even money, but
I missed, so I went the other way. If they don't hike, I got almost 10 to 1 odds. So I'm sorry. Way better than that.
If you want to bet against the March hike right now, you only need to buy contracts at 6 cents. Think about it. I mean, it's a huge long shot bet. I would not make it, but it might not be the worst thing. Like, are you going to average down your no bet?
Well, what I'm hoping for
is another variant that makes them not raise rates. You sick fuck.
No, but I went out to June because I did want to bet on 2 rate hikes by June, and can't. The market priced it in.
I have both those bets. I have more than 2 rate hikes before June, and I have I have 2 rate hikes by June, and I have the March hike.
Anyway, I'm a contrarian.
You're trying to be a contrarian. On Kalshi, I have found go with the direction of the crowd.
Of course, and that's the same thing with all markets. Go in the direction of the crowd.
The crowd is going to be right, dude. The crowd. The one time I went against the direction of the crowd was my Omicron bet on there. I said it would not be the dominant variant by February.
Actually, I made the worst bet of all time.
Oh, well.
I made the worst bet of all time. Will Omicron be more than 1% of all cases? This was like when it just started.
And then you closed it?
I said no. It was like 90% of all cases.
1%. You didn't give yourself a lot of margin of error there. I think 7 rate hikes is excessive. I think inflation peaked in early January. I said it on the show. We're already seeing the data that I'm right.
What happened? Would they invert the curve? Probably. I mean, no, almost certainly.
They're not going to have a reason to. Do you know that the 2-year Treasury has literally gone up 100 basis points in 3 months or 6 months? Like, we're already at 1.18 on the 2-year Treasury. We're already tightening financial conditions. I understand they're still buying assets into March, but so what? Like, we're already in a place where money is not free anymore. I don't think the Fed's in a rush to do 7 rate hikes this year. That seems a little bit outrageous.
The Goldman Sachs Financial Conditions Index has started to tighten a little bit too. So,
Vanguard is saying Vanguard is very hawkish. I read what's his name, the economist.
Joe
there.
Davis.
We like him. I read his piece, or the people that work under him in the economic research part of Vanguard. They think 3% will be the ceiling in this.
For what? Fed funds?
Terminal Fed funds for this cycle. Yeah. I don't think so.
I don't see it.
We hit 2.5% in 2018. The world almost came to an end. So I could be wrong.
It is hard. Here's why. It is very difficult to see the 10-year getting. Look what happens when it gets to 2%.
Yeah,
the amount
buyers
of
come out.
So how does it get to 3 or 4? I mean, the world changes. Maybe this will change, but I just think that the money.
I'll buy a 10-year Treasury for 3% all day long.
There's a permanent bid for yield, and I really think that keeps a ceiling on how high they can go.
Yeah. All right, let's go to viewer topics. Where's Duncan?
Duncan.
Beehive.
Hey guys,
What's
going
up,
on,
Duncan?
dude? What do you got?
we have a really good crowd tonight. We have a look at the chat. You'll have to read back through the 1,500 comments later.
I'll do
Is
that
anybody
after this.
is anybody calling me thin? Does anybody notice I lost a couple of pounds?
Yeah, I think I saw that one in there.
A few, right?
Yeah,
Okay.
yeah.
Did you?
What do you got? I did. You didn't notice? Kiss
Yeah,
my
no,
ass.
we all know
All
this. Yeah. You're also, you're standing still. You're keeping up
trying.
the standing desk thing.
I'm trying.
I would be so tired. I have to
Okay.
sit.
All right. First viewer topic.
So,
it's enough chit chat with you.
Yep. Okay. Up first, we have Alex who writes, what are considered good price to earnings and price to sales ratios?
This
I know
is
it
a
depends
great
on the
question.
sector. I know
Wait,
it depends
let
on
him
the
read
sector, growth rate, interest rate, et cetera, but is there a good general rule of thumb? People ask this kind of thing a lot, so I think it'd be good to hear what
That's
you guys
a
have to
great
say.
question. I think people assume the lower the better, and that couldn't be further from the truth. Like if you're comparing two stocks, PayPal versus Square, and you're like, oh, well, PayPal's trading at 19 times earnings and Square's at 22. Like that is completely irrelevant, like 100% useless. And I think a lot of investors start out that way, or they'll look for companies with like a PE of like 4. And it's like, oh, it's 4 times earning. Guess what? That is a piece of garbage company. You do not want, unless you're doing this quantitatively and you're buying like a basket of cheap stocks, you do not want to handpick individual companies that are trading at a mega discount to the market. There is almost always, in fact, there is always a reason why that is the case. Duncan, what's so funny?
Just a comment. That's fine. Good.
Well, out with it. I want to laugh. I like laughing.
Is it inappropriate? Are you not able to repeat
No,
it?
I just someone said you look like Jude Law.
I'll take it. I'll take Jude Law.
No, it's
Handsome
not
man.
you.
I think
It's
we're
me.
talking about Josh.
Oh, I look like Jude Law.
Wait. Time out. This is funny. Thomas Carba says, "Eat some food, you waif."
Who's he talking about?
It's me.
Oh.
All right.
All right, Josh, what do you think about PE? What's a good PE? Like 15, 19? Are you a 15 or 19 guy? Where are you at?
Honestly, it's a total waste of time because there is no empirical evidence that buying stocks at the lower PEs alone offers any sort of protection in bear markets, alpha in bull market. It just literally doesn't do what you think it does. However, in the private market, how many times cash flow you pay for a business is really important.
Yeah.
Because that is what's going to decide how long it takes you to get your original investment back. The rate at which they're returning capital to you as the buyer. And I think a lot of public market investors have taken that concept and made absolute fortunes in the public market. The problem is most of that took place prior to 1990, and it's become less and less helpful as innovation, brand equity, some of the things we talked about on the show, with Kai Wu have become more important to other investors. So in the end, stocks are going to work based on whether or not people want to pay a higher price than you paid later on. And just the fact that you bought something cheap doesn't guarantee that. The other thing I'd say to Michael's point is anytime you hear somebody say that stock is cheap, ask yourself why. Just start with that question. Why is it cheap? Am I lucky? Did I trip over a pot of gold that no one else noticed? There's always a reason. And then the question is, will this reason persist or not? And sometimes it won't. and there's a really great opportunity with low PE, but oftentimes it will, and that PE is reflecting something very bad for either the company's competitive position or the runoff of patents or the management team or whatever. So just always remember there's a reason.
I think people would get in less trouble if they stayed away from very high, very low, and stayed at multiples that are sort of by and around the market, and you see like good earnings growth and margin expansion and stuff like that. You'll probably have a lot less headaches than if you try and buy really cheap companies.
I love that concept. Stay within like the 80%.
Yeah.
That's in the range. Okay, Duncan, what's next?
I just have a quick follow-up. If you could only have one of those ratios, like any of them, enterprise to EBITDA or whatever, which one do you think is most useful if you're trying to just get a sense of something?
People like to use enterprise value because it gives you a better perspective from like the buyer's point of view. It adds debt, it takes out the cash, and then so pick enterprise to whatever your denominator is, sales, whatever. It doesn't matter.
Because enterprise value is the market cap of the stock plus the outstanding debt.
Minus the cash. So it's what a buyer would pay for the entire
That's right.
business.
Okay.
Okay, right, so up next, we have a question from Dan who writes, what should be the emphasis of a young investor, capital gains or income investments? Why?
I mean, I feel like this is obvious, but what are you doing with the income when you're young? Probably very little. If you're lucky, you have a diversified portfolio of U.S. large cap stocks. If you're lucky, that income will be something like 2%. If you don't have $1 million invested, then 2% is not going to amount to much to actually do anything with. So you're probably not making investments as a young person based on income. That's not to say income is bad. It comes with certain investments that you'll make. It just should not be the focal point. I think,
especially when
obviously cap gains.
If you're trying to get income, like where are you even getting that from at this point in time? So if you were a young person who said, in the 90s, hey, like I am super risk averse, I just am allergic to volatility, and why wouldn't I get 5 or 6% in the 10-year? Yeah, fine, do it. But that's not the world we live in today. If you want to buy the 10-year because you're risk averse, you can get 1.5%. If you want to buy utility stocks or Verizon, you can get a couple more percent. But capital gains. Okay,
let's split the difference. There are a whole class of companies today, led by Apple, that in baseball you would call these 5-tool players. They can do it all. They spend increasing amounts on R&D. They do buybacks. They're doing a dividend payout. They're doing sales growth. They're like focused on all of the right things, and they're actually working for investors. And it's not just Apple. You could think about companies like Home Depot in that category. If you're a young person, maybe that's like a good place to be. And you would take that dividend income and rather than pull it out and try to spend it on something new, have that be automatically reinvested by your broker-dealer, which I believe any online broker-dealer offers. And that way you're getting that income, but you're putting it to better use than you might be able to use yourself. Does that sound like a good compromise?
It does. Do you remember back in 2019, Apple had a higher dividend yield than the 10-year?
Holy shit. Do you remember in 2012 when they started doing buybacks and started paying a dividend?
Shout out to Carl Icahn and
made that happen.
And Einhorn. They tag teamed that.
One thing on Icahn that I just learned in the last couple of days, I was reading about Bill Ackman's new position in Netflix, and at the end of an article they tell this little anecdote about Icahn and Netflix, and they were like he was like in there pushing them to sell the company. He was like, you got to sell Netflix. It's too much. They sat him down and they had him watch a season of House of Cards. And by the end, he said, okay, you shouldn't sell it. And I'm now an investor.
I think Icahn is the reason why Blockbuster went bankrupt. I can't remember the exact details of the story, but Business Wars was amazing on the story of Blockbuster versus Netflix. I'm pretty sure Icahn sunk Blockbuster.
All right, let's wrap this up. We've already run over. I want to thank everybody who joined us live. We appreciate you guys. Thanks for coming out. Thanks for making the show bigger than ever. For the latest in financial blogger fashion, check out idon'tshop.com. That's where you see all of the official Compound gear. Thanks for flashing that. Great job tonight on the charts, John. Great job, Duncan, with viewer topics. Once again, there will be an all-new Animal Spirits podcast first thing tomorrow morning. And join us for the Compound and Friends at the end of the week. Special guest, Peter Bookvar. All things macro, inflation, all that good shit. Peter knows everything. We're going to have a lot of fun on that show. All right, guys, we'll see you next Tuesday. Thanks again.